Chapter 3 asks the simple but powerful question, which is better, stocks or bonds? Peter Lynch answers plainly, both have a place, but over the long run, stocks have given far higher returns, at the cost of more obvious short-term risk. The chapter walks through why that's true, what has changed for bond investors in recent decades, and how to think about risk so you can play the market like a skilled poker player rather than a terrified gambler. In the 1970s and early 1980s, interest rates ran very high. Anybody who bought long-term treasury bonds around 1980 and held them through the rate decline enjoyed both generous coupons and capital gains as yields came down. That made bonds look like a brilliant low-effort investment. No research, no newsletters, just reliable income. Then came the innovation that changed ordinary savers' lives: money market funds and bond funds. These let regular people escape the low returns of bank passbooks and certificates of deposit and participate in short-term yields that rose when interest rates rose. The money market plus the later convenience of check writing made cash-like accounts a practical alternative to old savings, and for many investors, especially during volatile markets, that was a welcome refuge. But Lynch's central point is historical and blunt. Over the long run, stocks beat bonds. He cites the long-term average returns to show this. Since the year 1927, common stocks have returned about 9.8% a year on average, compared with approximately 5% for corporate bonds, about 4.4% for government bonds, and about 3.4% for treasury bills. Those differences look small on a single-year basis, but compounded over decades, they are massive. For example, he shows that a hypothetical $20,000 invested in corporate bonds in 1927 would have become roughly $373,000 after 60 years, whereas the same $20,000 in stocks would have become about $5.5 million. The stock premium is the wealth builder, but caveats abound. Stocks are riskier. Giant, famous companies can and do disappoint. Lynch reminds us of household names that faded from prominence or stagnated for decades. A so-called safe blue chip can lose value or underperform for a very long stretch. Buying even a sturdy company at a bad time can produce years, even decades, of mediocre returns. Likewise, bonds are not riskless. Rising interest rates can hammer bond prices. Callable features let issuers take back attractive yields, and municipal and corporate defaults, though rare, do happen. Lynch refuses the lazy binary that treats stocks as gambling and bonds as prudence. Instead, he reframes investing as disciplined gambling, or better, as a game where skill, information, and discipline tilt the odds in your favor. He uses a 7-card stud poker analogy. In poker, you see a lot of information face up. Skilled players evaluate the odds and raise when the probability favors them, fold when it does not, and accept occasional bad beats. Investing is similar. By asking the right questions about a company's earnings, cash flow, and competitive position, you reveal the face-up cards and can judge whether the odds are in your favor. Good investors accept that some proportion of their picks will fail. If 6 out of 10 or 7 out of 10 behave as expected, that is more than enough to produce great results. Practical consequences from the chapter. If you want safety and zero volatility, keep money in cash or money market funds. That can be the right choice for short-term needs or for true risk aversion. If you want long-term growth and can tolerate volatility, stocks historically have been the superior choice. The premium exists because you are an owner, not a lender, so you share in the company's growth. Risk is not an abstract label. It depends on timing, price paid, and the investor's behavior. Buying great companies at the wrong price or the wrong time is risky. Buying troubled companies with a disciplined thesis and margin for error can be less risky than blindly buying safe names at sky-high valuations. Treat investing like stud poker. Calculate odds, add to winners, trim losers when the fundamentals change, and accept that occasional bad luck is part of the game. Lynch ends the chapter with a morale for the reader. Don't be paralyzed by the risk label. Stocks are risky, yes, but that same risk is the source of the outsized rewards that make wealth possible. With homework, discipline, and a poker player's temperament, you can tip the odds in your favor and use stocks to compound wealth over time.